All right, slow flippers, here's the $1,000,000 question I get all the time. Do you fund your infinite bank policy first and then borrow from the deal? Or do you just pay cash for the property and let the rent checks fill the policy later? It's the difference between pouring into the reservoir now versus waiting for the stream to trickle in later. And spoiler alert, both work. But the math, the psychology, and the stress level, those are totally different stories. Wait, so I can either get paid sooner or later? Why is that even a choice? So let's frame this with two doors. No pun intended. Door A, you fill the reservoir first. Lump sum goes into the policy and you borrow against it. Door B, you build the stream first. You pay cash and then drip premiums in later. Simple, binary. The choice you make here could be worth 6 figures over your investing career. Now imagine two people start with the same 100K. 10 years later, one of them has a compounding snowball. The other has a really tired-looking snow cone. So let's look at door A. Fund the policy first. With door A, the big dollars start compounding immediately. That's the entire game. Let's say you drop 100K into the policy. That's 100K earning uninterrupted compounding, tax advantaged for decades. You borrow against it to buy the property. Yes, you do now have 2 levers to manage, a policy loan and a premium. But the levers are yours, not the bank's, not Wall Street's, yours. Upside, compounding on day 1. Complete control over your payments. Liquidity buffer if life throws curveballs. Death benefit and protection turned on from the start. And guess what? If the deal ROI beats the loan rate, you're stacking wins. Of course, now you're paying yourself interest, which sounds weird, like I'm charging myself rent for my own couch. Now, door B feels easier. You pay cash, you fix the property, stabilize it, and once rent checks roll in, you start sending premiums into the policy. That means no policy loan interest up front, no immediate premium pressure. Psychologically, it feels clean. The biggest upside here, simplicity while you stabilize. Lower stress if rehab or lease up runs long. But here's the rub. You've delayed compounding. Your dollar cost averaging into the policy over time instead of front loading growth. And the liquidity stays trapped in the property until you refinance or sell. And protection starts later. It's like planting a tree, but instead of planting it today, you say, nah, I'll start with 1 leaf a month. In 20 years, one guy is sitting under an oak tree, the other guy is still watering a shrub. So how do you choose? Well, you pick door A if you've got reserves, you trust your cash flow discipline, and you want velocity. This is the fast lane flywheel approach. Money works in 2 places at once. Pick door B if the deal is heavy on rehab risk or if you just want to keep things simple until you build confidence. This is the training wheels approach. Fewer moving parts, less stress. Either way, the wrong choice is doing nothing because opportunity cost doesn't care about your feelings. Great. Another thing I didn't know was costing me money. Add it to the list. Gym memberships, streaming subscriptions, and apparently not compounding. So reservoir first or stream first. Both doors can get you there. One prioritizes speed and compounding. The other prioritizes simplicity and peace of mind. So remember, it's not about picking the perfect door. It's about picking the door that actually keeps you moving forward, because sitting in the hallway waiting is the only strategy guaranteed not to work. With that said, when you control your income, you control your outcome. To your prosperity.